Guys, good morning. Great to see you both. Joyce, we've been listening closely to JP Morgan's well-known quant, Marko Kolanovic, whose view is that some of these inflation-related numbers could begin to cool and the market would essentially sigh a sigh of relief. But this ISM number is not moving in that direction. What is the risk that doesn't play out?
Well, I do think that there's value that's emerging in the markets right now. I mean, if you're looking at the equity market on small cap, some of this is at like a 20-year low. So we're seeing pockets of value, but the market is focused on the Fed. And we are at the end of QE and rate hikes to begin. And in addition to core inflation, there are the concerns about higher energy prices, what that could mean for inflation. We have a home price appreciation index that's up 12.5% this year, and there's wage inflation. So some of these concerns are going to be with us. But overall, I think the growth picture is going to hold in pretty well. We're going to see some weakness in the December and January numbers from Omicron, but that's going to hit more the consumption side. We don't see the same type of supply chain issues emerging this time around. So overall, the fundamentals are still there, but I do think we're in for a period of shorter and more volatile cycles. But there's also value that's emerging, and we're really seeing some pockets here.
Brent, are you of the view that, yeah, we might get some short-term volatility, but in the more medium term, markets can sort of resolve a rising rate environment with still an era of better than average nominal GDP growth, better than average EPS growth?
Absolutely. And I agree with actually Jane's counterpart, Marco. I do think you're going to see inflation pull back. Current inflation has been caused by shifted demand towards goods. And so while everybody's pointing to the ISM this week, and certainly the prices paid was up, but supplier deliveries, I think in my first look, was actually down just a bit. If you look at last week's GDP, you're starting to see evidence that consumers are shifting back. And so you've had tremendous goods spending, which has, quite frankly, kind of harmed our supply chain. That is now alleviating. For the second straight quarter, consumers went back to services, and you saw that big inventory rebuild. And so I do think you're going to see inflation come off the boil, which is going to give the Fed a bit more of an easier path. They certainly will still tighten, but they're not going to tighten the economy into submission. And I still think you'll see strong economic growth. And eventually, that strong economic growth will pull the markets higher, but in the cheaper segments of the market. There are certainly still cheap parts of the market, like the S&P 600, that trades at 14 times earnings in 2022. That is not just relatively cheap. That's absolutely cheap, and that's where I'd have investors focus.
Joyce, where would you have investors focus?
Well, I think that on the small cap, we're seeing value here, and also on the commodities. I mean, we still have a lot of focus on the Russia-Ukraine conflict. Now, full-scale military invasion, we don't see that as being likely, but the talk of sanctions and export controls means that there could be more upside pressure to commodity prices. And this is asymmetric because there's upside pressure and there really aren't that many downward risk as well. But I'd also look outside of the U.S. In total, we see 14 out of 23 developed market central banks hiking rates. And one that does stand out is actually China, which is desynchronized from the global economic cycle, still putting in some modest easing, more credit easing, but one more RRR cut. And the valuations really did cheapen over the course of 2021. So we are seeing value here, but we could be in for a period as we go into what we see as 5 Fed hikes for the rest of the year, where the volatility just becomes something that we have to live with.